all for joining us this afternoon. I'll just go through the PowerPoint, some of the points covered there. Hopefully it won't take more than about 25 or 30 minutes, and then I'll turn it back over to Laura to see if there are any questions from the audience. I think to start things off from a global perspective, the U.S. at the moment is really something of an island in the storm. We're alone among the three main economic blocs, the other two being Europe and China, that really is showing much economic momentum at the moment and growth at more or less at a satisfactory rate. Europe, of course, dealing with deep-seated structural problems that has kept growth very low over the past several years. All that aggravated by the British referendum in late June, surprising vote to actually leave the European Union, simply adding to the uncertainties in the economic outlook, certainly for the UK, spilling over to Europe. And given the fact that the European Union is the largest economic grouping in the world, even larger than the U.S., there undoubtedly will be some economic fallout worldwide. China in the midst of a very difficult economic transition, moving from export and investment-led growth to a more consumer-led economic expansion. All this taking place while debt burdens are rising, financial strains are building a bit. All that to say that the U.S. has returned to what has been historically a traditional locomotive role for the global economy. If you go back to the 60s and 70s, we found that the U.S. typically led the global economy into recovery and actually led the world into a recession. A lot of that had to do with our economic size and the strength of the U.S. economy. Unfortunately, that locomotive is a good deal more truncated now. We're a smaller share of the economy. As recently as just a few decades ago, we were about 35% of world output. Now we're only down to about 18 or 19%. And of course, our growth rate is a good deal slower now. Even our potential growth rate slower than what it had been in the 1960s and even through the early 1970s. All that to say that the U.S. economic outlook, if you look at the bullet points on page 2, just going through some of the highlights, and then I'll try to develop them as we go along. Looking ahead, economic growth at the moment is fairly moderate, and we expect to see that moderate economic growth continuing through 2017. We're in the midst of an 8th straight year of economic growth. This makes this expansion, as disappointing as it's been, fairly long by historic standards, certainly longer than average. The silver lining is that moderate economic growth is prevented or at least lessen the risk of bottlenecks developing, which drive inflation higher, drive interest rates higher, create disruptions in the economy. We've had less of that because this has been a slow but steady economic growth cycle. There are risks out there, but the 2 to 2.5% growth rate that we expect to have seen in the second quarter, and those numbers will be reported later this month, we think more or less will continue. That should be the average growth rate that we see right through 2017. California's growth rate, economic growth is slowing, judging from the employment data that we have through May. The June numbers will be out in another week or two. A lot of it continues to be led by the high-tech sector and more broadly by what we call export industries. More on that a little bit later. But there has been a ripple effect beyond that to construction activity, business services, even government, which should be good news for the Sacramento area, spilling over in effect to the domestic economy. And while California's growth rate probably will become more sustainable after some very rapid increases in 2014 and 15, we think that that growth will be sustained right through 2017. As far as interest rates go, the Federal Reserve, we think, will be on hold until about the middle of 2017. This is a forecast that we keep pushing back. The Federal Reserve is anxious to what we call normalize interest rates, bring them back up more in line with the economy's growth rate, And even inflation, as low as it is, by most standards, most estimates, interest rates are well below what we would expect, even at today's moderate economic growth rate and low inflation. The Fed's anxious to move those rates up. It took a first step, of course, in December, but we don't think it'll be making the next move until about the middle of next year, even though economic growth is adequate enough. Inflation, we think, is holding steady, will actually move up a little bit with a few hot spots that I'll discuss a little bit later on. It's really the global situation, the uncertainties there, and the disruption, the strains that the Fed could aggravate if it were to raise interest rates, sending the dollar up, having a ripple effect not only on emerging markets and commodity prices, but the debt repayment burden by those dollar debt holders overseas. Longer term, intermediate and longer term interest rates, more market related interest rates, are tied somewhat to the Fed's actions, but they're also tied to the outlook for inflation, conditions overseas, and political events. And we think that as we move through the election campaign with all the uncertainties there and some of the uncertainties in the global economy, we can expect to see interest rates become a bit more volatile, not really moving up in a big way, but interest rate volatility increasing. And I might add that when the Federal Reserve actually begins to raise shorter term interest rates, and that begins to ripple through other parts of the market, there is the risk of more volatility as well because of the financial distortions and balances that have developed, many of which are similar to what we saw in 2007, 2008, into 2009, really more by nature, not degree. We don't expect to see the kind of meltdown by any means that we saw about 7 years ago, but it still could be fairly disruptive, and I think we have to be prepared for that. The longer term view, there are opportunities out there. We think that they will help to return growth to a more normal level, but we think that for now, at least, over the next several years, there are restraints out there, mainly in terms of demographics and the labor market, which we think will keep economic growth fairly low by historic standards before these opportunities could be realized. Now, turning to the U.S. economy, just to detail a little bit more the growth rate, as I mentioned, we think will be fairly moderate. I think the defining feature so far in this cycle, at least of late, is really a split personality between the strength in non-manufacturing led by consumer spending and housing, and weakness, relative weakness in manufacturing activity. The chart on page 3 shows that economic growth did pick up, gain momentum in the second quarter after a weak first quarter of the year. This has been fairly typical during the 7-year-long economic cycle. Very moderate, very stop-go. And coming out of the first quarter, you can see that non-manufacturing, which is the dominant sector of the economy, about 85% of total output, is on the leading edge. This is a purchasing manager survey showing the breadth of that strength, but also correlates well with economic momentum. And while manufacturing is lagging, you can see that even manufacturing activity is recovering from what had been a recession in manufacturing during the latter part of the year. The fundamentals driving consumer spending, income growth, household wealth, we think support moderate gains in consumer spending. And on top of that, households should be getting an added shot in the arm from the latest decline in fuel prices, gasoline prices over the past couple of weeks, and also from the increase in refinancing activity. Mortgage rates are back down to a 3-year low. That's encouraging a lot of refi activity. More people are eligible now with the rise in home prices. More mortgages are above water, allowing them to qualify for a refi, and that frees up income by reducing mortgage payments for added consumer spending. Housing, likewise, even though home prices have been rising at a pretty good clip, the fact that mortgage rates are down relative to income means that housing affordability, the ability to qualify for a mortgage, is high, still high by historic standards. Now, turning to the California market, as I mentioned, California's economy seems to be losing a little bit of momentum, although compared to the U.S., our growth rate, judging from the employment data, has moved back above the U.S. rate. Through May, our employment growth rate over the last 3 months, using seasonally adjusted data, was over 2%. That compared to a U.S. growth rate of about 1.8, 1.9%. Since then, in June, growth has slowed further. The loss of momentum was to be expected following very strong growth for a period of time in the latter part of 2015. In terms of the region, California is really three economies. If you look at the slide on page 5, you can see that broadly we have two relatively high-cost coastal areas, broadly based economies, the Bay Area and Southern California. And then the third broad regional economy is the Central Valley, the Sacramento area, the Bakersfield area, to some extent feeding off the strength or weakness in the Bay Area and in Southern California. And of course, agribusiness, government, regional operations important there as well. I think what stands out in this chart is the fact that the Bay Area continues to outperform the other parts of the economy. The Bay Area driven to a greater extent by technology, the strength in the high-tech industry really transforming the San Francisco economy. High-tech is fairly big in Southern California as well. It's just that the economy is so much larger, so much more broadly based. It just doesn't provide quite the same lift as it does in the Bay Area. Now, as I mentioned earlier, a lot of the strength in the economy is coming from export industries. Export industries here are not only industries that derive the bulk of their revenues from overseas, it's those industries that derive the bulk of their revenues outside the local economy, which covers not only overseas, but the rest of the U.S., if it's a local economy, the rest of California as well. The footnote down on the bottom of that chart describes some of the broad export-oriented sectors. I think they're pretty well known. In addition to technology, we have aerospace, tourism and travel, motion pictures, the entertainment industry in general. And those industries have done very well. Prior to 2013, a lot of the strength early in this growth cycle was coming out of housing. We continue to see good strength, as I said, in construction. Business services, very economically sensitive, not shown in this chart, but the strength that we're seeing there with growth of about 3.5% to 4% in jobs year over year is a good sign for the economy. It means that white-collar employment, this is an amorphous sector covering advertising, legal, data processing, and the like, is picking up the strength, is reflecting the strength in the state's overall economy and growing at a good clip. But still, the leading edge is in those export industries. Even as they slow, that growth rate is still above the overall average. And that's important as a locomotive because it means more money is coming in from the outside. If much of our revenues are generated from outside the economy, it's sort of like fiscal stimulus, money being pumped into the economy, and we get the ripple effect on more domestic-oriented industries like construction and retail trade. Looking ahead to California, as I said, we think the pattern will remain in place. The Bay Area remaining on the leading edge of the strength in the economy. I might add the economy is more highly charged now than it was in years past and decades past as technology has taken on an increasingly important role in the growth, particularly in the Bay Area, to some extent in Southern California as well, and rippling through the entire economy. And what we've seen is greater volatility, certainly in the Bay Area, than what we had seen historically. Historically, San Francisco, for example, which is really ground zero in this tech-led recovery, has been a very high value-added economy, but more of a mature, steady-eddy economy keyed to banking and business services servicing the tech industry. Now we've had technology moving into the local economy directly, social media, data processing, services, and the like. And what we've seen is greater volatility there as well. So it's been something of a double-edged sword, and we could see that reflected in statewide economic growth depending on the outlook for high tech. Now turning to the interest rate outlook, the As I said, the pattern of interest rates we think has been and will continue to be somewhat unusual. Normally, in this late stage of an economic cycle, we would expect to see the Federal Reserve coming in, raising short-term interest rates to contain a rise in inflation. This time around, of course, the Federal Reserve has the luxury, if you will, of not having to worry as much about inflation, overall inflation at the moment. The key issue is what's happening overseas, the global economic conditions. And we think that the weakness in the global economy, the shocks that we've been seeing, the latest being the whole Brexit vote, will have the effect of keeping the Fed on the sidelines until the middle of 2017. What we've seen with other interest rates is a real fundamental change, and I don't know how well the next chart picks this up, but what we have in the bold line in this chart is the difference between U.S. and German interest rates. Now, typically, when those interest rates are rising, it means that the dollar is moving higher. Interest rates are driving the dollar higher against, say, the euro. When those interest rates are declining, the dollar becomes less attractive and it tends to fall. What we're seeing this time around is the interest spreads are as they have widened out, we've seen more capital being attracted to the U.S., and those spreads have actually narrowed, the bold line. Now, this chart is a little more difficult to read. I've expressed the thin line as the euro's exchange rate, not the dollar. When that line is moving down, it means that the dollar is moving up and the euro is moving down in value. Typically, when interest rates are moving down against the European area, you would expect to see the euro rising against the dollar because those interest rates are more attractive overseas. This time around, the euro is declining in value, and what that means, we think, is that as interest rates fall overseas compared to the rates here, money is attracted to the U.S. As it's attracted to the U.S., it drives the demand for dollars up, driving up its exchange rate, driving down the euro, and at the same time driving U.S. interest rates down simply because demand is growing. The concern is that for us, if the Fed were to raise interest rates, this would attract even more money to the U.S. It might suppress our interest rates, but by driving the dollar still higher, it would just simply add to the weakness in manufacturing. All that to say that the Federal Reserve, we think, will be more reluctant to raise those interest rates, not only because of the strains it creates overseas in the financial markets for dollar debt holders and in other local markets as money moves out of those local markets, but because of what it does to our own competitive position. Now, as I said, the market-driven interest rates we think will become more volatile. A lot of it has to do with the election campaign, the uncertainties there. The two sides are still very polarized, the Republicans and the Democrats. Aggravating that are the uncertain policies that are likely to be developed, depending on whether it's not only a Republican or a Democratic president, but who wins, who gains in the Congress, who loses. Republican control could have an important influence, even if a Democrat is elected. Even if a Democrat is elected president. Even in the inflation area, though, there are a few hot spots which could create some issues. Just scrolling ahead, the chart on page 9 shows you the anatomy of inflation. And you can see that there's a large segment of the CPI that is accelerating. Services, excluding energy, that includes housing, but it also includes a whole array of business services, consumer services, financial, and the like. And that rate has been accelerating steadily, reflecting the relative strength of the U.S. economy. And currently, that rate is at a 7.5-year high. The reason it doesn't show up in the overall rate, twofold. One, energy prices have been declining, fuel prices, gasoline, and the like. That doesn't show up in this chart. And then on top of that, because of the strength in the dollar and the weakness overseas, we're seeing import prices actually fall. And that means that our own pricing power for manufacturing industries, other trade-sensitive industries, that pricing power is undercut. They're forced to lower their prices to compete against foreign firms selling into the U.S. market. And that, between that and the weakness overseas, that helps explain why goods prices, the bold line, using the right grid, is actually negative. In other words, we have deflation there. Prices are actually declining year over year, and even on a rolling 3-month basis. And that creates a potential hotspot, and that could create an issue if energy prices stabilize, as we think they will around the turn of the year, and if for whatever reason the dollar's exchange rate no longer is rising, that could, in effect, remove the veil of some of these restraints on inflation, and inflation quickly could become something of an issue for the Federal Reserve. And as that rate is moving up, if in fact it does, that could simply add to the volatility in the financial markets, the volatility in interest rates. One other source, the financial distortions that I mentioned earlier, slowly unwinding. If you just follow me to the slide on page 10, you can see the balance sheet, some of the good news and bad news, and comparing the financial market to the situation back in 2008, 2009. The good news, we don't have a housing bubble to the extent we did back then. Certainly home prices are rising, but we don't see the kind of leveraging off that. We don't see the broad-based excessive increases in home prices that we had back then. And the financing instruments are a good deal less sophisticated now. That created the problem with mortgage derivatives and subprime lending. Just less of that going on now. Household debt burdens are a good deal lower. Household debt is beginning to rise. We have a student debt issue and the like. But given the deleveraging that we had between 2008 and about 2012, debt payments in relation to income still at a very low level, about the lowest we've seen in the last 30 years, even as it begins to slowly rise again. And so households aren't quite as exposed. On top of that, as I mentioned, fewer subprime mortgages. The bad news is that the shadow banking industry, less regulated than traditional banking, has grown rapidly as regulations on the banking industry have increased. They filled the void in lending. They're a much larger share of the banking industry, of the financial services sector now than they were back in 2008. And on balance, given that they're less regulated, I would say the overall financial system now, despite all the well-publicized increases in regulations that we've seen on banks, is probably less regulated now than it was back in 2008, 2009. On top of that, some of the regulations on banks have created a liquidity problem. Banks, for example, historically have served as important intermediaries in the corporate bond market. They've held large inventories of corporate bonds. It's more expensive to do that now, so the inventory that banks hold is smaller. Their intermediary role is much smaller now, and that leaves the corporate market a good deal more exposed. I might add exchange-traded funds, very liquid for the investor, but very often investing in less liquid investments. And that point was brought home again right after the British referendum vote, when some of the real estate funds there had to suspend redemption activity because they couldn't liquidate their holdings, obviously, quickly enough to meet the demands of investors in those funds. Just a few months back, there was a high yield fund in the junk bond market that had to do pretty much the same thing as redemption activity by investors began to pick up. The other three elements there, pretty much similar to what we had back in 2008, 2009. Generally, I think they all come under the heading of just a relaxation of discipline. Leveraging, it's become more of a seller's market for these assets. People are piling in a reach for yield. Underwriting standards are breaking down. Asset values are being inflated a bit. Banks under heavy regulatory burden and with interest rates moving down, squeezing the margin between their funding costs and what they can get on investments and lending activity. Their net interest margins being squeezed, that's squeezing financial services stocks, all that acting as a constraint on lending as well. And that could create an issue for the economy, given that credit is a lubrication for economic growth. If we're restrained there, that could act to slow economic growth as well. Just one final point. I'm already closing in on my 25 minutes. Just taking the longer view, the issue now is: are we consigned to this sort of subpar economic growth forever? Will we return to more normal growth? I think some of the issues out there that come into play are the first two that are listed there in particular. We are looking at weaker labor force growth. Population growth here is slowing. New entrants to the labor force. The pool of labor is not growing as rapidly as it did 20 or 30 years ago. That's one important component of growth potential. The other is how much you get out of each worker, what we call productivity growth. And this is a real hot button issue in economics right now, but for a variety of reasons. The increase in productivity, a key component of long-term growth potential, is a good deal weaker now than it was 10 or 20 years ago. Part of it reflects slower economic growth. Part of it reflects the slow introduction or absorption of technological changes, the nature of technology. There are a whole array of issues, but the bottom line is that of late, productivity has actually been declining, and the two together have had the effect of lowering long-term growth potential. I think for the improvement to occur, either we relax immigration policies to boost population and labor force growth, or we come up with better ways of improving productivity through economic policy. The other issue is a mismatch in the labor market between skilled and less skilled positions. And I think there's an interesting chart that sort of reflects that. The final chart in the handout. Job openings are still growing at a very rapid the growth has slowed from an unsustainable rate, but at just over 7% year over year, jobs that are being created are still growing at a fairly good clip. Hiring, though, actual employment is growing not nearly as rapidly, less than 1% by May from a year earlier. We'll probably see an uptick in both in June, just given the employment numbers that came out last Friday. But the difference between openings and hiring, probably due to a number of things, but at least one is due to the fact that while there's a large pool of less skilled labor, the demand for the supply of skilled workers, not only in technology, but skilled manufacturing, where a large number of baby boomers are retiring, and in other areas such as transportation and the like, not nearly as plentiful as we would like to see from just given the growth in job openings. There are a whole array of other issues that we think ultimately will produce more rapid growth. Unfortunately, they probably lie out beyond the next several years. I think I've listed them in the chart on page 11 if you have access to that. But at this point, at least, why don't I close here, and that slide is up on the board. You can see some changing consumption patterns. Younger people, millennials, are continuing to consume at a pretty good rate. Changing consumption patterns for retirees, the baby boomers, shifting more towards services, financial services, travel and the like, certainly opportunities in the investment area. The need for improved infrastructure, by some estimates, $1.5 to $2 trillion in required investment. The real task is to improve the financing vehicles for that partnership between the public sector and the private sector. The technological advances in manufacturing, 3D manufacturing, and other advances are producing a reshoring of manufacturing back to the U.S., circumventing the need for cheap labor, and that could provide a lift to economic growth down the road. I think the advantages that we have in the global economy certainly are apparent given our relatively strong growth rate, and this should serve us well down the road as competition remains keen. And one other element there that I think will bode well for the U.S., but certainly enter into the equation on relative strength within the global economy, is the ability not only of the U.S. but other countries to shift toward more effective growth policies. Some of the areas that have been untried, the structural changes in labor markets, not only here but overseas, deregulation in some areas, while they may open up opportunities for stronger growth, are probably the most politically difficult decisions that have to be made. That third arrow of Abenomics in Japan, for example, still untested, in part because of the political hurdles really restraining growth. But I think at some point, the global competition will force those more fundamental changes, and hopefully that will contribute to a more rapid growth rate down the road. With that, let me turn it back over to Laura, see if you have any questions about anything I've covered or anything I've missed, and I'll do my best to try to answer them. Laura?
Thank you, Gary. We have had a few questions roll in, so I will just kind of read them off how they have come in. First question that was asked are, what are the chances of a recession this year and next?
Well, we think the probabilities naturally will go up as this growth cycle ages. Stresses and strains, even though they're more limited now, do develop as we go through these growth cycles. I think that the biggest, and by the way, this is a question that's asked of economists in some of these consensus forecast surveys, and for what it's worth, the probability assigned by most economists now in some of the surveys I've seen is on the order of about 20 to 25% probability of a recession this year, rising to about 30 to 35% in 2017. In other words, well below 50-50, but a perceptible probability. I might add that, looking at the traditional stresses and strains in the economy, really looking in the wrong places. The risks in the outlook to me are really more non-traditional, more in the financial markets. For example, the asset price inflation that we've been seeing, if those asset bubbles in some of the markets suddenly begins to go into reverse, we could see a situation, like I said, similar in nature but not degree to what we went through in 2008 and 2009, as people de-lever, as banks pull back further, or financial services pull back further on their lending. Banks, as I said, are under pressure to pull back on lending, and if the pressure is great enough, that could constrain economic growth and tip an already vulnerable economy, slow-growing economy, into a recession. And then the third element really has to do with the low level of inflation itself. Businesses are facing rising costs, particularly labor costs, slow but steady increase in wages, which is a good thing in driving consumer growth, but business pricing power remains fairly weak. The ability to pass along those higher costs as higher prices, the result is a squeeze on margins, profit margins, and that is constraining profit growth, and it could encourage businesses to put a lid on hiring and wage increases down the road. That's the raw material for income growth, and it could put a consumer-led growth in some jeopardy.
Awesome, thank you. Next question. What does your outlook mean for California home prices?
Well, California has done very well. These have been pockets of real strength in the economy. Affordability remains strong, less so here in California, given the very rapid run-up in prices. But given the low level of mortgage rate, certainly low enough to support a slow but steady recovery in the housing industry, perhaps not as rapid as what we've seen in parts of some of the regional economies in California. Looking ahead, the most important thing is the economy itself. Growth, we think, will moderate. We think we'll avoid a recession right through 2017. We're not looking for a material backup in interest rates, one that may temper affordability somewhat, but ongoing gains in the labor market, improvement in consumer confidence, we think will continue to support moderate growth in home prices and part and parcel of that, a moderate growth in housing activity, construction activity, and the like. And I might add, some of the stronger areas may begin to move further inland as affordability is pressured in some of these urban areas along the coast. Certainly the inland areas that border, including the Sacramento, the Modesto area north, and areas, the exurbs of the Los Angeles economy, Southern California economy, the Inland Empire, and the like, should continue to benefit from that spillover effect, given their affordability advantage.
Great, thank you. The next question that came in is a fun one. Which presidential candidate is less a threat to the financial market?
Well, that's an interesting question. When you get into the particulars of some of the proposals, I would say that assuming that the presumptive nominee Donald Trump is the standard bearer, some of his proposals are very business friendly, and by extension should help support the further gains in the stock market. He's looking to lower the corporate tax rate, bring it more in line with the global average, put us at less of a competitive disadvantage, which has encouraged companies to relocate overseas and take advantage of the lower tax rates there. He has proposed some changes that would encourage the repatriation of something on the order of about $1 trillion in corporate overseas profits that are kept overseas because of the burdensome tax rate here in the U.S. that would apply to those repatriated funds. Hillary Clinton, if she is the Democratic nominee, really in favor of a more progressive tax system, could benefit holders of longer-term investments, the private equity funds, because she would hold the line on capital gains on longer-term investments, but the capital gains tax would be increased. The short-term capital gains, and it might even be extended out just a bit. She's in favor of a more progressive tax system, higher tax rates for upper-income individuals, and that could weigh on small businesses, those small businesses that are operate as proprietorships or even subchapter S companies. The problem is that while some of Trump's specific tax proposals are certainly advantageous to the business sector, some of the broader sweeping proposals against some of the trade agreements, against immigration, some of the broader policies create such uncertainties that most business analysts feel that on balance, Trump would be more of a negative just in terms of the uncertainties he'd create for businesses, the spillover effect that would have on business investment and hiring. So like a lot of things in economics and politics, something of a double-edged sword. We just have to see how those policies played out. And of course, a lot depends on the makeup of the Congress, who's controlling not only the Senate, but the House of Representatives.
Great, thank you. Just a reminder, if anyone wants, we do have a handful of more questions, but to ask questions, you can type it into your control panel on the right-hand side of your screen. Next question, what does your outlook for unusually low interest rates here and negative interest rates abroad mean for the U.S. economy and the financial market?
Well, I think, again, it's been something of a double-edged sword. We certainly see a whole array of markets benefiting from this reach for return, reach for yield. Not only the stock market, certain commodities, emerging markets are just beginning to excuse me, benefit from a greater influx of funds after investors pulled back. The high yield market here in the U.S., the non-investment grade market, benefiting as well. But it is creating a number of distortions. For one thing, as I mentioned earlier, suppressing interest rates, squeezing banks' net interest margins, profitability, their potential for lending means that credit might not be growing quite as rapidly as it would otherwise. Secondly, it's certainly not great news for savers, people that rely on short-term money market instruments, CDs, and the like. These interest rates are being kept low, and that's weighing on their income returns, especially retirees and older individuals that are more inclined to save rather than invest. It's also encouraging very risky financial engineering. Businesses are seeing their debt burdens rise, not because of productive investments, which can expand their top line down the road, but for stock buybacks, which are an important engine behind the stock market's rally. Some of it is investors reaching for return and somewhat riskier investments, but for the first time since 2011, the shares outstanding in the stock market are actually down a bit. So by restricting supply, they're nudging those stock prices higher, but they're doing it by financing on debt. They're borrowing to maintain or increase dividend payments, which are very attractive at the moment. To some extent, takeover activity, restructuring, which can have a productive side, but not nearly as productive as an increase in investment, and inflating asset values generally, leaving the economy vulnerable. So, it really is a double-edged sword for the U.S., and I would say, on balance, probably more of a negative by keeping the markets artificially low in their interest rates than they might otherwise be.
Thank you. Next question. You mentioned limitations on growth potential, demographics, and labor force factors versus post-war history. Can you elaborate a little on that?
Well, we had the most notable change was in the baby boom generation in the 1970s and into the early 1980s. Population growth was not only strong, but the cohort entering the labor force was quite high. So we had labor force growth on the order of about 2 to 3%, perhaps north of that at times, and that provided a pool of labor. And at the time, the skilled labor and a lot of it was manufacturing related. Manufacturing employment here was a good deal higher than it is today, and so it opened up opportunities for the blue collar middle class and the like. Productivity was a good deal stronger as well, right up to 1973 when we had the big increase in oil prices. Labor productivity, that is output for a given amount of labor input, was growing at about a 2 to 3% rate. So you had a growth potential that was upwards of 4%, maybe even stronger than that, for a variety of reasons, as I mentioned. Most obviously our population growth is slowing. Even the slowing that we're seeing is better than what we're seeing in Japan, where population is actually declining. In Europe, it's leveling out. It's going to be leveling out and declining here by the end of this century, but it certainly is growing slower than what we saw earlier. And as I said, we're just not getting the productivity gains. Typically, when the economy is growing more slowly than what it normally can be expected to, productivity growth, it sort of feeds on itself. Productivity growth begins to wind down. The opportunities for expanding output for a given amount of labor becomes more difficult. Businesses tend to hold on to workforces, especially if they have a certain skill set, reluctant to lay them off to try to simply boost productivity in this market unless they absolutely have to. The argument about technology, automation, certainly boosting productivity, but creating some uncertainties about the investment outlook there as well. So, again, simply put, labor force growth, productivity growth are the two essential ingredients in determining an economy's potential growth rate. And certainly since 1973, and then more recently since the deep recession in 2008, 2009, we haven't gotten the gains in productivity that we'd like to see. Policy uncertainties may enter into the equation. A heavier tax and regulatory burden may be involved. A whole list of explanations, the ordering of which difficult to say.
Wonderful. Just a couple more questions. Next one, is there anything in today's Beige Book release that alters the overall outlook?
I don't think so. I think the Beige Book was pretty consistent with what we're seeing with economic growth. If I would take issue a bit, I would say that growth certainly early in the second quarter came out of that first quarter in reasonably good shape. Now, this survey covers the latter part of the second quarter, and there is evidence that growth already was losing a little bit of momentum, but still fitting into that 2 to 2.5% growth rate that we expect to see down the road. What concerns me is that there may be a certain complacency developing with inflation. Inflation overall has been quite low, and that's the way it's been reported in the Beige Book today. Generally subdued, little sign of price pressure. While that's true in general, as I mentioned, and as you saw in that one of the visuals, we are seeing pressure in a large component to the CPI, and I think the Fed has to be mindful of that. I'm sure they're seeing what I'm seeing there as well. They probably don't want to alarm the markets by pointing to that pressure, but I think investors have to be aware of the fact that if the dollar stabilizes, if energy prices stabilize, and we lose some of those restraints on the overall inflation rate, we could see a more noticeable pickup in inflation than anticipated. I think what it does for policy, the growth that it's describing, even though it didn't lay it out in numerics, the modest to moderate economic growth rate that they were describing by itself might be adequate, just barely, for the Federal Reserve to resume raising interest rates in conjunction with the kind of inflation rate that we're seeing, which is still moderate but modest, but much like growth, edging a bit higher. But the overriding consideration at the moment is the global economy and the uncertainties there. And I don't think that the domestic situation, as outlined in the Beige Book, really changes the outlook for Fed policy and interest rates in a material way. It does give the Fed the leeway to keep its powder dry and wait for greater clarity on some of the unsettled issues in the global economy.
Thank you. Last, we'd like to ask if Tony Melville is available. Can he call?
Yes, let me put you on. In fact, let me turn the headset over to Tony. Tony's our portfolio manager, of course, managing the CalTRUST account. Hold on one sec.
Thank you so much.
Hi, this is Tony.
Hi, Tony. One of our final questions is if you can comment briefly on the strategic positioning of the CalTRUST portfolios in light of this outlook, and are there any significant changes being contemplated?
Well, I wouldn't say significant changes, but I'll go over the changes and the potential for change that we see going forward. As most participants probably know, there are two portfolios that I work on, a short-term and a medium-term. Short-term currently running a duration of about a half a year, and this has been consistent. This fund is designed for shorter time horizon investments, and so we keep this one a little bit shorter. I don't expect the short-term portfolio to change much over the next few months, at least duration positioning, with any slight change in interest rate outlook that Gary described going forward. The medium-term portfolios for a longer time horizon investor, it's roughly benchmarked off of a 1 to 3 year index, which has a duration of 1.9. This portfolio currently is at 1.74, and with the interest rate outlook that Gary just, what we do see happening, or the goal with this portfolio is as interest rates edge higher, we'd like to add some duration to the portfolio. We'll still be slightly short of that 1.9 year duration, but we'll get it closer to 1.9 as 2 and 3 year rates move up, and we'll do that opportunistically. Coming out of our most recent meeting back in April, we mentioned that we wanted to do this as well, and we talked about the 2 year getting to up to close to 90 and 3 year getting up to the 1.15 range. There was an opportunity to do that, so we did push the portfolio out to a 1.8 year duration, and now we're going to sit back and wait and see if rates can move up a little from here. We have had a backup in rates over the last few days, with the exception of today, so we were monitoring that and probably look to target of, say, 75-80 basis points on the 2 year. That would be a good time for us to get back and extend the duration of the portfolio. But we still would be short to neutral to short, slightly short. But certainly our outlook has changed then just from, say, 3-4 months ago, with the most recent events and the Fed really signaling that they probably will be on hold, as Gary said, until sometime next year.
Wonderful. Thank you so much, Tony.
You're welcome.
There are no further questions popping up, so this will conclude our webinar for today. I'd like to thank everyone for attending, and especially thank Gary and Tony for presenting today. This webinar has been recorded and will be available on our website next week. If you have any follow-up questions, please do not hesitate to contact me. My email is Laura, L-A-U-R-A, @caltrust.org. Thank you, everyone.
Thank you.